and we were nowhere near the base on this one. I mean, we got so overextended. The free money that we printed from '08 to, well, till really 2022, so distorted the economy that if we don't keep that money flowing, this economy is going to keel over and die. I mean, that's a mathematical fact. And to me, it's rather astounding to me the bluffing game the Fed has played because, to me, they're like the guy who jumped out of the building and, I'm flying, I'm flying, I'm flying. And they're going past the 10th floor right now. And this is not going to end well.
Lawrence Lepard joins us today. He is the founder and managing partner of Equity Management Associates. We'll be talking about his views on the current macro landscape, the opportunities and risks for investors right now, and what sound money is. Lawrence, welcome to the show. Good to host you.
Thanks, David. Nice to be back. Congrats on your new channel. I've been watching your work, and it's great. So
I
good to be
appreciate it.
here.
My audience is a big fan of your work as well, so I'm very happy to reconnect. Sound money, you're an advocate of it. What is it? How do you define it? Let's start from there.
Yeah, perfect. So sound money is money that the government can't print. I think the biggest problem in our society today is the fact that the federal government, U.S. federal government, but really all federal governments or all governments are just using the printing press to try and paper over and solve problems. And so sound money traditionally has always been gold for 5,000 years, silver to an extent as well. And of course, Bitcoin is emerging ultimately I think will become the soundest form of money. But I really consider those three to be the sound money triad, gold, silver, and Bitcoin.
I've heard that argument before. Yeah, very good point. However, we don't transact with gold, and most of us don't transact with Bitcoin on a day-to-day basis. So can you still call it money if it's not the universal medium of exchange, at least where we live in North America?
It's a great point. And, what will happen over time, I believe, is that money will kind of break into two different categories. One will be transactional money that you use to pay your bills. And of course, the leading candidate in that area these days is the dollar. I'm not sure that'll always be the case, but we accept that it is the reserve currency and everything is priced in dollar terms. But then when it comes to your savings, where are you going to store value? I mean, store of value is a important property of money, of real money. And obviously, I would submit that the dollar does a shitty job of storing value and that gold and silver and Bitcoin do much better jobs of storing value. But admittedly, it's certainly hard to pay for things in gold and silver terms, but it's pretty easy to convert gold and silver into dollars. And it's not as easy to pay, or it's not that hard to pay for things in Bitcoin terms because of the Lightning Network. Although, a lot of people still don't accept that. So I'm looking at the store of value function of money, sound money. I believe over time that the rails will be put in place to make these sounder monies also payment technologies as well. But right now, everyone pays in dollars. We know that.
So if I can summarize your overall wealth preservation thesis, it's to store your wealth in sound money and then transfer that to fiat when you need to buy things with it.
Exactly right. That's exactly right. And I keep the minimum amount of fiat that I need, but obviously I got to pay bills and they're dollars. So as I need dollars, I'll either sell gold or sell Bitcoin.
Okay, I want to start with your investment thesis first for 2024. Now, as you know, 2023 was surprising for a lot of people given how well equities performed. Bitcoin also surprised to the upside for a lot of people who are calling for Bitcoin to see a downturn this year due to deteriorating economic conditions. First of all, do you think the economy deteriorated throughout 2023 by any metric whatsoever before we talk about 2024?
That's a great question. Well, if you listen to the government statistics, no, everything's great. The problem is that there's a disconnect between what they say and what I think is really going on. Under the surface, first of all, I think that a lot of the economic statistics are cooked. I mean, for example, look at the employment numbers. They're continually, they report great employment numbers and then they revise them down. I mean, the last 8 or 9 months, almost every single revision has been downward. GDP is growing very rapidly. But if you actually reported inflation correctly, I would submit we're already in a recession that GDP is not growing, that the growth you see is just because we actually have inflation of 10 or 12%, and therefore, it shows some growth at a nominal level,
Whoa,
not at a real level.
Sorry, what do you mean we have inflation of 10 to 12%?
Well, I think that the inflation statistics are and have always been cooked. And if you go and you look at shadow government stats, you look at the Chapwood Index, the headline inflation number now is in the 3% range year on year. And my guess is I don't think there are many people who are actually experiencing 3% year on year inflation. In fact, in the most recent report, they showed healthcare dropped 34%. They recategorized it in some funny way. And of course, I don't think there's anybody whose healthcare dropped 34%. So, the problem is we're dealing with government numbers that aren't real numbers, which makes, investing a very tricky exercise in these kind of conditions.
Yeah, I'm familiar with John Williams Shadow Stats. I've had an interview with him myself as well. He recategorized or recalculated inflation using 1980s methodologies,
Right,
which is
right.
before the government changed their methodology. But even then, his measurements showed inflation coming down. It's still high single digits, low double digits per his estimates, but the trend, the trend has been downward.
There
What
is
do you
no
make of
doubt.
this trend?
Yeah.
Yeah.
Go
So
ahead.
what do you make of this trend? Are we going to continue to
Well, I
see
mean,
downward
look,
inflation?
yeah,
Yeah.
look, we're heading, so interest rates run up quite a bit, and obviously that took the bloom off the housing bubble where you had rents and house prices going up 15 to 20% a year. Now everyone's frozen in their 3% mortgage because the new mortgage rates are in the sevens. Um, People are starting to get laid off. We're starting to see a slowdown in the economy if you look at it on a lot of measures. And so, yes, there's no doubt that inflation has come down, and inflation tends to move in waves. I mean, obviously the first wave, remember that in 2020 they thought inflation was too low. They were not meeting their 2% target, and then they said, it's getting a little higher, but they said it was transitory. Of course, then we know it broke out like crazy based on all the printing they did in 2021 and 2, and it got as high as 9%. Then they slammed on the monetary brakes by taking interest rates up by 525 basis points. And of course, that has slowed the monetary velocity and slowed the growth in the money supply. And so there is no doubt inflation is coming down. We can argue about how you measure it, but you're right, the trend is lower. And by the way, it might continue lower if they don't resort to money printing again. But I think that it's a fact that given the debt construct that we have and given all the debt that's out there, if we truly do not start to, resort or, go back to money printing, things are going to collapse. I mean, we're going to have a depression, and we could actually have negative inflation prints or something that's very deflationary, but only because everybody's losing their job. And I think it's interesting. I see two things going on, David. I see deflation in assets like houses. I mean, they've stopped going up, they're flat, or in some cases they've gone down. But I see inflation in the stuff you need, like gasoline and food. I mean, those prices are still much higher than they were before this whole episode started.
Right. Yeah. Okay. I am going to come back to what you just said. I didn't forget what you said. We may see a depression if we don't get monetary stimulus. Let's segue into the Fed now before I come back and ask you to elaborate on that. I'm just reading a news summary here. The Federal Reserve policymakers appear to be likely done raising interest rates. This was the overall message from Fed Governor Christopher Waller, who noted that any rate cuts will be aimed at ensuring monetary policy does not become overly tight as inflation recedes. This is from his speech a couple of days ago, as you know. What do you make of Waller's message? Do you agree that?
Well, yeah, it's interesting to me. I mean, when you look at what happened this fall, as you'll recall, the 10-year was kind of marching steadily higher and crossed the 5% rate level, and that was really starting to create problems in a lot of different areas. And they're arcane, so I won't go there. But suffice it to say that that was creating problems, and Powell was saying higher for longer. But at the same point in time, in about a 3-week period, you saw 8 or 9 Fed governors come out and say, well, maybe we're tight enough, and maybe we're reaching a terminal rate, and maybe the market is doing its job for us, and we're not going to need to hike anymore. And one of the ways you can validate, and that changed market sentiment. And from that 5.0, print on the 10-year, we've lost 60 basis points very quickly here. We're down into the 4.4 range. So, I think what happened, and I think it was because of that jawboning. And I think what the market is perceiving, if you go to the CME website, you can look at the odds of future rate cuts. I mean, the CME, odds are saying market participants are betting that the Fed is going to start cutting rates in the first or second quarter of next year, and it's going to do between 100 and 200 basis points of cuts next year. And I think what the market is becoming aware of is the fact that the economy is rolling over. We've seen some major bankruptcies. We saw Yellow Freight, and we've seen some others. We've seen companies like Walmart missing guidance. We've seen, the grocery stores missing guidance. I mean, it's not, the economy is not plunging, but things are clearly slowing down. And I think the market is saying, and all these Fed speakers have signaled that they're done. And I believe they are done. They're not going up again. Now, Powell keeps saying, well, we're data dependent, we could go higher. That's because he doesn't want people to start baking in inflation expectations. He's hoping to keep everybody thinking that he might go higher, but I don't think they can go higher. I think if they go higher, something's going to break. And I think they kind of know that. And there were some clues. There were various things breaking. I mean, earlier this year, as an example, we saw something big break, Silicon Valley Bank, right? So, the rate hiking it works with a lag. You hike the rates, things don't break the day after you hike them, but it flows through the system and it becomes a problem.
Yeah, let's talk about that for just a minute. Silicon Valley, Signature Bank, you and I hadn't had a chance to connect during March. Those bank failures were those micromanagement issues of not balancing their treasuries or books and matching their treasury durations properly like they should have? Or is that a systemic banking issue where we may see another Lehman-style dominoes effect?
That's a great question. It's the right question to ask. I mean, I think it's a little bit of both. I mean, clearly in both of those cases, they bought long duration govies at low interest rates, and they had deposits that could flee. And what happened is, as those govies went underwater, somebody did the math and said, you know what? You don't have any equity left. You've got big losses on those bonds, and therefore, as you know, Silicon Valley, one of the Silicon Valley venture firms said, "Hey, pull all your money out of this thing," and you had an old-fashioned bank run. So that was somewhat mismanagement on the part of Silicon Valley Bank. But I think the issue is actually broader because I think everybody. I mean, remember we had free money from '08 to 15, and so kind of 0% interest rates, and I think everybody bought low interest rate long-term debt, and if you did, you're looking at a loss. And let me tell you another area it's not just Silicon Valley and those guys, First Republic, but the one I'm watching very carefully is commercial real estate. I mean, the U.S. banking system loaned a ton of money to commercial real estate developers, and at low interest rates that will ultimately roll at much higher interest rates. And what you're seeing now is office buildings and multifamily property buildings, being sold for fractions of their prior price, and somebody's taking that loss. Somebody loaned, you have $100 million building, a guy put up 20 million of equity, bank, borrowed $80 million. The building's now worth 40. The equity's gone, and the bank is losing half the value of their loan. So, and that's there's 600 billion of that in the banking system. And I read a report that suggested that maybe as many as half of the U.S. Regional banks have negative equity, and so that's systemic. And I think as that continues to roll through the system, that's what's in our future. And so what I think we're being told by the market is that the market cannot handle these higher rates. And that's what gets me highly confident that the Fed will have to pivot and cut, and that they will substantially during the course of next year.
Yeah, you're right. I think it's like 700 banks at risk or something like that. Now, Lawrence, when you talk about the markets having a lack of confidence in the Fed, well, certainly the prices this year didn't reflect the lack of confidence. In the last 4 weeks, for example, huge rally in the stock markets. What's going on there?
Well, yeah, isn't that interesting? I mean, I think it's a buy the dip reflex. I mean, there's also been a big rally in bonds. I mean, I think one of the things that's happened in the bond market is people have thought, okay, well, they're going to pivot, they're going to print money, they're going to lower rates, and therefore a 10-year at 450 looks good because we're going to have lower inflation. I think the big mistake all of the markets are making is they actually think inflation is going to be under control and is going to come back down, and we're going to have a soft landing. I'll take the other side of that bet. I don't think we're going to have a soft landing. I think it's going to be a hard landing. As for the stock market, I can't really explain it. All I think though, it's a little bit of stock market investors thinking to themselves, you buy the dip, and it's always we know the Fed has our back. The Fed's not going to let anything bad happen. They will cut rates before the market goes down very much, and this will be just like every instance post 2008. The market takes a dive, the Fed cuts rates, free money saves us, and the market goes on to new highs. And it's entirely possible that that will happen. I mean, the valuations are quite extreme on the high side, in my view. But if the Fed decides to print a ton more money, they could become higher. So, I'm not short the bond market or the stock market, but I do believe that the bond market is picking up nickels in front of a steamroller because I don't think interest rates are really going to come down as much as everyone thinks.
Okay, so that's the key here. So you don't think they'll hike again? Do you think that they will cut rates next year, or do you think that they will maintain five and a quarter for as long as
I
they
think
can?
no, I think they'll start cutting. I'm where the CME market, futures guys are. I think they'll have to start cutting because I think they're going to start to get really bad news, and they're going to be very, very concerned. I mean, the Fed is always fighting the last battle. As you recall, they let inflation run very hot for a few years, and then they suddenly jumped in and went from 0 to 5.25. Right now they're saying they're going to stay tighter for longer, and they're not worried about the economy. Well, I think what's going to change, the narrative is going to shift, and suddenly inflation is, I mean, look, you're right. We are getting some better inflation prints. I mean, they're fake numbers, but they're better. And so I think eventually inflation is not going to seem to be as big an issue. It's going to be like, holy shit, this economy is rolling over and my neighbor just lost his job. Save us. And they're going to realize they've gone too far too fast, and they are going to work to try and save things. Now, unfortunately, with an unwinding bubble, I mean, they cut rates very substantially in 2002 to try and stop that bubble from unwinding. Didn't work. Still unwound. They cut rates substantially in 2008 to stop that bubble from unwinding. Didn't work. So I think they're going to cut rates here. I don't think it's going to work. I think that the economy is going to be bad in a year or 2 years time, and the fact that they've cut rates isn't going to. And ultimately, that I think that will flow back to the stock market. But that's just my view. There are a lot of smart people who disagree with me. I think the stock market will be fine.
Okay, so the notion that they're going to cut rates, isn't that great news for consumers? Then we're finally going to get a reprieve on our credit card interest payments, mortgages,
Well,
whatnot.
it depends on how quickly they pass it through. I mean,
Okay.
as you know, the credit card companies, they're sharks. They probably won't pass it through. But yes, it could be. I mean, certainly if mortgage rates came down from 7.5%, that would be a relief to the kids who are trying to buy houses. I mean, it's a whole different set of numbers. When you're buying a house, I mean, at 3%, that's one thing. You're buying a house at 7.5%, that's an entirely different kettle of fish. So, if they cut rates substantially and that leads to mortgage rates coming down, that would be good. I mean, they're the tricky thing here, David, is they're obviously, as you know, they're cross currents back and forth and back and forth. And any given point in time, it's impossible to know what's going to happen in the next 6 months, 1 year, etc. I prefer to dial out and take a longer term view. I'm not a day trader. I'm not even a month trader or even a year trader. I develop a macro thesis that I think is correct that'll play out over a 2 to 6 year time frame, and I invest my money and my investors' money in that form. And the thing that I'm very confident in is that we've got kind of a doomsday machine that will continue to be forced to print, and that will lead to monetary debasement, and that monetary debasement will lead to higher prices for those things which represent sound money. And so every investor needs to own some sound money.
Yeah, you addressed that several times that the Fed may be forced to print. Let me ask you this, Lawrence, why is that even on the table as a possibility? If they print, they risk higher inflation. They lose credibility completely because everything they've done or reported to have done to bring down inflation over the last 2 years would have been undone with renewed QE.
It's a great question, and you're right. I mean, the counter to it all is let's go back and review the Fed mandate. The Fed mandate is full employment. Got that, check. Although that's going to change. Control inflation. Nope, blew that one. Terribly out of control inflation. We're trying to get it back. The third mandate of the Fed that's kind of unspoken, right? But we know it's there because of how they've behaved, is functioning financial markets. Functioning and continuous financial markets without a panic. And we saw in March of 2020, when the bond market went no bid, the US government bond market went no bid, we saw what they did. They printed. They had to print. We saw in the repo blowout in 2019 what they had to do. They had to print. How the original Powell pivot. We saw in 2008 when the markets were cratering and Hank Paulson was begging Nancy Pelosi to give him the $700 billion for TARP, what they did. I mean, they printed. And what I would suggest is that although Powell is talking tough, and although they would prefer to be higher for longer and not have to print, I would suggest that I think there's a very high probability that financial conditions will get bad enough fast enough because of the mathematics of the debt growing faster than GDP, and therefore they will be forced into print. And by the way, it won't be a small print. I think another point that's interesting to make is that each of these cycles gets bigger. 08 happened, I mean, 2000, 2002 happened. They didn't really print much. They just took rates down to 1% and blew a housing bubble. 2008 happened, and they went from $800 billion balance sheet to 3 trillion over the course of 3 years. 2020 happened, well, 2018 happened, and they started printing again, went up a little bit. 2020 happened, they went nuts. They went from a 3 trillion roughly balance sheet up to 8 or 9 trillion dollar balance sheet in 18 months. And so, right now we're on the tightening schedule. We've got M2 going down. We're not printing. We're tightening, et cetera. We got QT reducing the Fed balance sheet. But if and when something breaks, and I believe it will, the next print is going to be larger than the last one. I mean, I could see a Fed balance sheet of 25 trillion, because the alternative is going to be literally, as they said, the ATMs don't work. I mean, they can't have the financial system collapse.
The ATMs don't work. Wait. Okay, we're skipping some steps here. How are we, okay, well, I think this is a good segue to go back to what you said earlier. If the Fed does not re-engage money printing of some sort, we're going into a depression, and then the ATMs stop working. All right, can you elaborate on that? What's wrong with the economy?
David, it almost happened in March. I mean, so there's $17 trillion of bank deposits in the United States, okay? And we had a bank run at Silicon Valley Bank. We also had it at First Republic and a few others. And, if you recall, Janet Yellen at several points in time said, we might have to backstop all of bank deposits. And, if right. Because the FDIC has got a couple hundred billion, and a couple hundred billion, for the deposits of 250,000 or less, that doesn't cover 17 trillion, right? I mean, it doesn't get it done. And so if they have a nationwide bank run, if banks start failing left and right, and they can't find JP Morgans to buy them all, and JP Morgan's going to be so busy they can't buy them all, they literally will need to step in and guarantee all the bank deposits, or they will need to step in and buy all the bonds. I mean, so that's what I say when I say things will break. And yeah, I mean, when a bank fails, I mean, if you call in the 30s, thousands, I think it was 6,000 banks failed in the 30s. And I mean, literally, and there was no deposit insurance. And literally, people had money in those banks. They lost all their money. They just totally. And I mean, do you think the federal government is going to allow, I don't know how many thousand banks we have in the United States right now, but do you think the federal government is going to allow half of them to fail? No, they're going to step in and say, we're guaranteeing all these deposits. Well, okay, fine, but that means they're guaranteeing $17 trillion. That's a lot more than the current Fed balance sheet. And the BTF, the thing they put in, the BTFP, is up 100 billion or more, but they also did a lot of stuff in the Federal Home Loan Board, and that's actually where they hid the bailout. There was closer to $1 trillion lent out there. And so, they will do whatever it takes to keep the financial system functioning. But, and that's fine, I get it, and they have to do it, but it's by its very nature, it involves money printing one way or the other, and that's inflationary.
Well, when you say depression, you herald back images of the 1930s, people standing outside in lines outside the soup kitchen, unemployment going up to double digits, which briefly happened in 2020 because of the pandemic. It reverted afterward. Is that what you're alluding to right now? An economic sort of collapse where many people lose their jobs?
I mean, it is. I mean, what if literally banks started failing left and right? Companies would say we got to cut back. I mean, a fractional reserve monetary system. We all learned in Macro 101 about the credit multiplier, and it's great it feels good on the way up. More people get employed people buy cars, more cars get sold, the auto company has higher profits. And wash, rinse, and repeat. Well, it works in reverse. So suddenly you lose your job because your company doesn't have as much revenue. Now you're unemployed. Now you don't buy a car. So pretty soon the car company starts losing money, and, wash, rinse, repeat, so the car manufacturing employees, they lose their jobs, then they can't make their mortgage payments. And it goes, bubbles tend to collapse back to their base. And we were nowhere near the base on this one. I mean, we got so overextended. The free money that we printed from 2008 to, till really 2022, so distorted the economy that if we don't keep that money flowing, this economy is going to keel over and die. I mean, that's a mathematical fact. And to me, it's rather astounding to me, the bluffing game the Fed has played, because to me, they're like the guy who jumped out of the building and, I'm flying, and they're going past the 10th floor right now. And this is not going to end well,
Well, okay, so why are businesses looking to lay people off more now, given that we know the Fed is near the end of its rate hike cycle? The worst in terms of interest expenses is behind us. If I were a business owner, I'm thinking
They're
I just
not.
hold it
I mean,
off for a few more
they're
months.
not,
Yeah.
and they remember the employee shortages of the pandemic, so they're taking their time doing it. And I mean, look, the best case scenario is we do kind of a muddle through scenario, and that might happen. I concede that, where businesses are not laying people off and rate cuts are coming, and they keep the economy going, and nothing really severe breaks. But I think there's some possibility that it doesn't work out that way or that favorably for them. And look, there's a chance, I suppose, that they manage to thread the needle. I mean, the system as it's constituted mathematically suggests that we're either going to have very high inflation or we're going to have an economic collapse. And that's just the math of the debt. Debt is extremely deflationary. Once debt stops being able to create growth, you're dead. And so without printing more money, the math is that the thing collapses. And so the question is, how does that collapse unfold? I mean, what they're trying to do is skate down the middle, not print too much money, but print enough to prevent the collapse. And the not printing too much is to try and keep inflation in bay. But they certainly got to print enough to keep the thing from falling apart. And it's tricky. I mean, I think they're in a lose-lose situation. I think it's going to be extremely tough for them to walk that middle line. But I concede it's not impossible that they could. I think it is possible, but I don't know. I mean, when you've got something that's as bubbled up as this whole thing is, once it really, and they know this too, once it really gets rolling, it's hard to reverse it. I mean, look at the dot-com collapse. I mean, the Nasdaq fell 80%, the S&P fell 50%. Look at the housing bubble collapse. The S&P fell 50%. Home prices fell nationwide, and it took a long time to come out of that. They kept interest rates at zero from '08 until 2015. That's 7 years of free money to try and arrest that last collapse. So, it's going to be dramatic, in my opinion.
I'll just ask you point blank. This is a question that's been asked to me a lot in my, in my personal friend circle. David, are we going to get a depression, or not even depression? They didn't use that word. David, are we going to get a recession next year? What do you think? What's your answer?
I think the answer is yes. I think the answer is yes. Now, whether it's really, terrible and super bad, I don't know. But there's just no doubt that we're going to have a meaningful economic slowdown. I think we've already had one. I just don't think the numbers are showing it yet. If you dig into all the minutia and all the numbers, I mean, I think we're already there. The tipping point has been reached. So clearly, we're going to have a slowdown. The question is, how severe is it going to be? And that's up for debate. I mean, I think it could be quite severe. Obviously, there are other people who think, no, it'll just be a slowdown. We'll find a bottom and then we'll be okay. And that's possible. I wouldn't say that's the high probability case, but it's possible.
Well, Lawrence, recessions have historically been disinflationary, if not outright deflationary events, at least for a short amount of time. Is this time going to be different?
No, we could trend toward deflation, but there are other factors that come into play here. I mean, look, probably one of the most important prices in the world is the price of oil, because everybody needs it and everyone drives and so on and so forth. And in past recessions and depressions or recessions or slowdowns, price of oil drops quite a bit. Price of oil really hasn't dropped that much, and there's some factors going on in the oil market that I think are going to maybe not allow it to drop. But even as demand softens in the U.S., it's not going to necessarily solve the problem. Well, and let me list those factors. One, we've got hostile parties in the Saudi Arabia, the Middle East, and Russia that will decrease production because they know that high oil prices hurt us and help them. We've got shale oil in the U.S. has really peaked. There's a lot of Rosenzweig and those guys have done a lot of work to show that we got this incredible bonus out of shale oil for the last 10 or 15 years, and those fields are rolling over. Supply is not increasing there like it was 5 or 6 years ago, so that's a problem. And then the third is, if you look at the amount of oil that's used by people in India and China, and there's roughly a billion people in each of those countries, that's really growing quite substantially. Both of those countries' economies, until recently, China's hurting now, but both those countries have growing middle classes. And guess what? The average American uses 5 times as much oil as the average person in China, and that gap is going to close. I mean, they're buying more cars, they're going to use more oil, and the same is true with India. So I think that, we could have a situation where even though our economy is slow and the US, maybe there are less people traveling, less people driving, less people flying, price of oil doesn't necessarily come down. So if that occurs, this goes back to my, asset prices might come down, but underlying things, the things you need aren't going to get cheaper. So that's kind of how I see it.
So here's my question. Once we have a recession next year, we may see the overall CPI come down a little bit. Whether or not you believe the government numbers is, that the trend might come down a little bit. At what point, Lawrence, does inflation come back? What will trigger a comeback in inflation?
Right. I think the Fed stopping rate hikes is kind of the beginning. The cuts are a little bit more of it, but still not too serious. I think everyone will hang on to the hope that it's gonna be a shallow downturn and they're gonna manage inflation. Everything's gonna be good. I think when they stop QT and they restart QE because the bond market is not happy with what's going on, and I think that's coming. I think at that point in time, everyone's going to go, oh shit, and the Fed's going to totally lose credibility, as you alluded to in this conversation earlier. I mean, but they're going to, as you point out, they're going to have some cover for it because they might have some favorable inflation prints and they might have a really soft economy, and they're going to just say, hey, look, we got to do this. I mean, yes, I mean, and they're going to say, they'll lie again. They'll say, yeah, you think inflation is coming back, but we don't. We see it as being under control now, and it's all good. But I think the market will quickly, what's going on here is more and more people come to realize that the Fed is really a paper tiger and they don't know what they're doing. The market will then conclude, oh, I get it. These guys can never stop printing money. And so there'll be more people who will be in my camp, which is shit. Given that I know that, I now can no longer really hold bonds, and really saving money in dollar terms doesn't make any sense. I've got to find some way to protect myself against this fact that they are going to print more money in the next 5 years. And I'm talking about over a 5 year time frame. I mean, this isn't necessarily a month by month thing. I mean, if you go back and you look at a chart on the inflation in the 70s, you see that it came in waves. And each wave, went up, and then it would come back in, and then it would go up higher, and then it would come back in. So you had higher highs and higher lows. And I kind of expect this decade to look very similar to the 70s.
Lawrence, you have here a chart showing the federal interest payments on debt. This was a popular chart of discussion throughout the year as it's skyrocketed to now $970 billion, just under $1 trillion. Interestingly, the federal tax receipts, so income on taxes, is just shy of $3 trillion. So we're getting close to a third of tax receipts being interest payments on debt. But just help us understand this. What exactly does this have to do with the markets? In other words, what are the market implications of high interest payments on debt? Why should investors care about this?
That's a really great question. Okay, so that's part of also what informs my thesis on inflation. As we know, the U.S. debt is large and growing very rapidly. As we know that by going from 0% interest to 5.25% interest, U.S. federal inflation or interest costs have gone up. They've skyrocketed. I mean, the chart looks kind of like a sine wave going straight up. And furthermore, that doesn't even reflect the fact that the average interest rate on the debt is still 2.7, and we're financing a lot of it short term, and the short term rates have gone up to closer to 5. But anyway, the U.S. federal budget deficit is $2 trillion kind of baked in the cake before a recession. And in every past recession, tax receipts fall by 5 to 20%, and federal spending, because of welfare and other things, go up by 5 to 20%. And so that 2 trillion is going to continue to get larger, and they're going to have to finance those deficits. They have to sell debt. Well, and they go out to the marketplace to sell the debt, and all of the things, ceteris paribus, all of the things being equal, there's only so much demand for the debt, and to get it sold, they're going to have to pay a higher interest rate. Well, if they have to pay a higher interest rate, that means their interest costs are higher. Guess what that means? That means the deficit is bigger, and that means they got to sell more debt. And so what I'm describing is what's been called a debt spiral or a doom loop, where, the more they try and solve it, the worse it gets. And so I think that, the notion where I think the market has it wrong is the belief that the bond market is going to put up with continual debasement, and that interest rates people are going to come, inflation is going to come back down, and people are going to be comfortable holding bonds. I just don't think that's going to happen.
So you've outlined one option, which is to monetize the debt. The other two options they have is simply to cut back on spending and or raise taxes. How would
Correct.
you evaluate
And
these
when people look at coming into my fund, I always warn them. I say, look, here's what would make what I'm doing not work. Okay. And of course, and I describe the circumstances and they laugh because we all think these are low probability, but it's not impossible. If they were to say, we are going to means test Social Security, we're going to means test Medicare, we are going to close down half of our military bases overseas, we're going to chop our military budget by 50%, we're going to stop sending money to the Ukraine and Israel and all these places overseas, and we're going to literally balance our budget, balance the U.S. federal budget. That would be a very different investment picture than what we're looking at, and what I'm describing would be as certain or as high probability a bet as I believe it to be. But I describe those things, and then you look at what's going on in Washington, D.C., and I just don't see any evidence that anyone's aware of that or thinking in those terms. I mean, they have a continual kind of kick the can, and until it becomes a crisis, they don't deal with it. That's been the historical observation of the government, right?
And you don't think that, well, raising taxes is unpopular, but it's not impossible, right?
It's not impossible. No, what I've described could happen. There's no there's no question it could happen, and maybe it will. I mean, look, I think there's a very small piece of the Republican Party that is where this is trying to do that, but I don't think they represent a big enough block to get anything done. And the Democrats certainly aren't interested in going there. So.
Okay, so let's pivot to the markets now. I'll give you the following four options: S&P 500, Bitcoin, gold, or bonds. Which of these four will perform the best next year? Which will be worst?
Bitcoin will be the best. It's a little bit of gold will be second best. It's a little bit of a toss up on the bonds and the S&P 500. They're both overvalued, and there are a lot of cross currents. I mean, bonds could catch a bid here as we kind of go into a recession.
Sorry, bonds are still overvalued despite dropping like 40-50% over the last 2 years.
Yeah. In my view, we've got a lot of inflation in front of us, and the bond market is not fully absorbed that. But in turn, the stock market has rallied. I mean, it kind of amazes me. We had the bubble burst, in my opinion, in December of 2021. And we've rallied back. I mean, we're within spitting distance of a new all-time high in the S&P 500. And that's kind of amazing to me, given the situation that we have here. And so if I had to guess, I would actually guess stocks might perform worse than bonds in the next year. Because the bonds, I think, have a little bit of a bid from the deflationary slowdown that's coming. But I think in the longer run, I think they are both at risk and don't even come close to comparing with what I consider to be substantial upside in gold and Bitcoin.
Well, let's talk about Bitcoin first, and then we'll move on to gold. The argument that Bitcoin is sound money has been disputed. This is one of the arguments. Please address this. How can something be sound money if it goes down 60% in a year? Right, that's one argument. How you've heard this before. How would you answer this?
It's a great question. It's a good point. It's sound money, but it's in the early adoption phase, and most of the world doesn't really know what it is. And so it tends to run hard, and then crash hard. And there's a lot of sound and fury around it. And there was a lot of fraud. And there was a lot of, bad stuff going on. I mean, FTX being kind of the poster boy for all of that stuff. And, I actually think, I mean, one Bitcoin is one Bitcoin. And that, in a sense, in my view, because there are 21 million of them and it's limited in supply, it is the soundest money on the planet. I mean, its stock to flow will eventually become infinite because there will be no flow. But it's in an adoption phase, and it's done this repeatedly. It runs hard and then it corrects 80%. And actually, I would say this: each of those corrections has been slightly less in terms of magnitude. I think the first one was 90%, then 80, then 75, and over time, as the adoption gets to be broader, it gets to be more widely understood, the corrections are not as large. But it does seem to trade, in a very volatile fashion. And, but it's been the best performing asset for the last 15 years. I mean, it's crushed stocks, it's crushed gold, it's crushed everything. And I think that's going to continue. To me, it's the most upside, lowest risk asset on the board. And I know that's hard to believe that it's, low risk with this potential for a downside crash, but remember, my time frame is 5 years, 10 years, 15 years. And so I think we'll continue to excuse me, repeat these, big up, big down swings.
What's going to drive massive adoption of Bitcoin? Is it mostly from the utility side, or is it mostly from the investment side?
I think it's store of value and investment. I mean, the one that's coming that we're all aware of, and I think is a big, big mover. And I was reminded this morning of how, when the gold ETF came out, the price of gold was in the 300s and it went to 1900. I mean, I think there's a big piece of the investing public that would like to own Bitcoin. I think there's a lot of money that's in RIA, registered investment advisor managers in the United States, and they're thinking, hey, it makes some sense to have an allocation of this. It's been a good performer, and its Sharpe ratio is good, and so they would like to buy it, but they can't. They're not going to go buy a Trezor and cold store it, and they don't want to buy a GBTC because it trades at a discount or premium. It's a different animal, and so to me, one of the things that's going to ignite demand for it is when all these pools of money that are out there that right now can't legally buy it because it's not on the board, so to speak, are able to legally buy it. And that ETF is expected to come in the first half of next year. So I think that will be a big catalyst to taking it to 100,000 plus. And, it's at, what is it, 36 or 7 now, but, and then, much higher longer term. But, to me, it's a store of value asset. Now, the Lightning Network is coming along and making transactions very cheap and very easy to use, but that's just early days. I mean, to me, the Bitcoin, I was an investor in the dot-com stuff back in the day, and to me, and I got in '93, I started buying internet stocks, right? And that worked out well because they went crazy until 2000. And to me, the Bitcoin's kind of a similar thing, and I don't know, maybe we're kind of at the 1999 level on or 98 level on Bitcoin. I mean, it's like it's got a long way to go. I mean, there's just it's and in the early days of the internet, it was very hard to use. You had a dial-up phone, you had AOL, you had all that stuff, and right now Bitcoin is hard to use for payments. You need a Lightning wallet, you need somebody who's going to accept Lightning. And except for in these small Bitcoin havens like El Salvador, that doesn't exist. So it's going to take time for that to exist, but it will. It'll come.
One thing that has been talked about a lot is companies using or putting Bitcoin on their treasury. Elon Musk did it for both SpaceX and Tesla. He sold most of it earlier this year and last year, so they weren't on their books forever. But do you think that's going to be a trend for more companies?
I do. Yeah. I mean, I think, as more and more of the world comes to accept that this is the soundest form of money that's ever been created, that it's a commodity with a limited supply. I mean, remember, every commodity in the world, you increase the price, you get more of it. Price of gold goes up, we're going to mine more gold. Price of oil goes up, you drill for more oil. Price of anything, wheat goes up, we'll plant more fields. And but Bitcoin, the supply is mathematically set and it's decreasing asymptotically towards zero. And so the price could go wherever it wants to go. The supply is not going to change. That's really different. That's really unique. We've never seen anything like that before. I mean, the thing I think a lot of people don't understand is just how important and different Bitcoin is. This is what these guys did. This is an invention or a creation of digital sound money. Before Bitcoin came along, everything in the world that was digital was copyable. You could copy a file, you copy music, copy a video, copy anything. It's a digital thing. You could just make 1,000 copies. It was free. That was one of the beauties of a digital system. And other people were trying to create digital money. There've been there's a whole history of of cash on computers, and the problem, nobody could ever solve the double spending problem. Nobody could ever solve the variability problem. I mean, there was no immutable way of measuring the supply and preventing people from faking and therefore debasing the money. And the Bitcoin, what they developed with SHA-256 and the halvings and the difficulty adjustment and everything, the miners, etc., they developed legitimate digital scarcity. So, I mean, kind of compare it to like before the Wright brothers put fabric and wood together and an engine and got on it and flew, man had not been in the sky except maybe in a hot air balloon. And then suddenly man was flying. And that's kind of, think of it in those terms. I mean, there was no digital scarcity until Bitcoin got invented. And we know that for money to have value, it must be scarce. That's why before Bitcoin, gold was the best money we had. There's a fixed amount, or not a fixed amount, but there's an above ground amount. It grows very slowly, 1.5, percent per year. And to find gold is hard and expensive and takes time. So, and it's all the same. It's one block of gold. I mean, different grades, but if you've got 24 karat gold, you got 24 karat gold, and you can recast it and so on and so forth. And so gold was the best form of savings money in the world, pre-Bitcoin coming along. And Bitcoin really just figured out a way to create a digital form of gold. And arguably it's even better because, every 40 years, the supply of gold doubles on the world because you take the 1.5 and compound it. Whereas, the supply of Bitcoin is fixed at 21 million. Now, it's going to take a little time to get there, but we're at 19 now, so there's not that much left to be mined.
You've no doubt heard the counter argument. Well, look, this just sounds like a Ponzi scheme, right? You've got a limited supply of some digital asset, and the only thing driving up the value is demand itself. At least for gold, you can put it in jewelry or semiconductors. There's some industrial use case.
Right.
But it sounds like, yeah.
And that's a fair point. I mean, gold has a physical use. It can be used for jewelry. It's used in electronics. But think about it for a moment. What money, Karl Menger, the founder of Austrian economics, said, money is the most liquid good. It's what we all agree to accept in trade for goods and services. Okay. And really, if you think about what money is just me. If I say to you, I want an hour of your time, you say, okay, that cost me X. Or if you say to a farmer, I want some of that beef that you've got there, he says that costs you Y. And we use dollars as the thing because that's what's been defined as money. But money is really just a ledger. I mean, you don't have dollars in your bank account. You just got digital entries in a computer. And that's always been the case. Even before gold existed, people were sitting in caves and they've seen them. They made stick marks. And so people were, saying, okay, I killed 3 bison, you killed 1, you owe me 2. And so money is really just a way of keeping score. And it's hard for some gold people to get around that, but it's a fact. Now, if 2 things could make that not work, the first would be if it weren't truly immutable and there was a problem with the technology. And to be honest with you, that was always my concern. I bought my first Bitcoin in 2013, but I didn't really get bigger into it until I saw us go through all the fork wars and all the different issues. And by the way, in the early days, there were issues. A lot of people working on it were like, we're not sure this thing's going to work. I mean, my thought was, hey, it's based on a computer and computers blow up. I mean, I was around when the IBM PC came out, and I lived through the 80s when my computer would go blue screen all the time, and I'd unplug it and plug it back in and reboot it and hope that my file was still there. And so that's one risk to Bitcoin that the technology blows up. But we've now got 15 years and 800 plus thousand blocks that have been mined. It's pretty good proof of concept. So I think the odds of that are low. The other thing that could stop it, though, David, and it's a legitimate concern, is if people didn't agree to use it. In other words, if everyone said, yeah, okay, fine, it's digital scarcity, but who gives a shit? Do you know what I mean? Yeah, it's digital scarcity. I don't care. Okay. So if user adoption were to slow, or people were to lose interest in it, or the use cases were to decrease, then it could become just an odd curiosity on the side and nobody would really care. But I watch very carefully, and all of us in the Bitcoin community watch very carefully, and that's not the case. We see more addresses. We see more use. We see more use cases. We see more adoption. We see the Lightning Network making it easier to use in transactions. And so what we see is underlying. I mean, admittedly, it's not like the whole world uses Bitcoin today, but I mean, maybe we're getting closer to that Malcolm Gladwell 10% tipping point where 10% of the world says, hey, you know what? This is a superior savings technology and I want to own some. And of course, eventually, 10 in Gladwell's model, 10% becomes 90% once you hit that tipping point. And so, I think we're getting pretty close to that tipping point. And I mean, as I say, the 2 things that would cause me to be concerned about Bitcoin would be a technical failure or use cases slowing down or adoption slowing down. But in most of the metrics we measure, the usage of it's growing 15 to 20% a year compounded.
Okay, that certainly answered my next question as to what could change your mind. So thank you for that. You mentioned that Bitcoin could outperform the other asset classes that I mentioned, which is stocks, bonds, gold. Why do you think that Bitcoin would outperform stocks? So we know that Bitcoin has historically been closely correlated with the Nasdaq. Are you then assuming one of two things is going to happen next year? Either the stock market is going to rally, Bitcoin will rally more, or Bitcoin will decouple from the Nasdaq?
I think both of those things might happen, but I
Okay.
definitely think they're different assets, they're different things, and I think over time Bitcoin will decouple from the Nasdaq. I don't know what the Nasdaq's going to do next year. In a crack up boom, the Nasdaq's going to go up, Bitcoin's going to go up more. The reason why I think Bitcoin is the best performing asset is I think you have two things working for it. Number one, you have monetary debasement taking place. We talked about that earlier, right? We think the government is locked in a doom loop where they're just going to have to continue to print money in order to keep the system functioning. So that's first principles. You start there. That'll make everything go up in nominal terms. Houses will go up, stocks will go up, everything will go up because there's more money chasing the same amount of stuff. Okay, so that's point one. Point two, though, on Bitcoin is you've got an adoption curve. There's 7 billion people on the planet, maybe 8, I don't know. It's a big number. How many Bitcoin addresses holders we got? I mean, maybe 100 million have some Bitcoin, maybe. I mean, if the trend that I've observed so far, what I call the dogs eating the food, if more dogs keep eating the food every year, 100 is going to become 120, and then it's going to become 140. And you see where I'm going with this? I mean, and it just more and more people will be using it, adopting it, and believing in it. And it'll, in a sense, become self-fulfilling. It's a network effect. And a good comparable to it actually is, and people say, well, why couldn't it be beat out like, Facebook beat out, MySpace or whatever the hell it was. And I say because it's a network and because it gains value. It's Metcalfe's law talks about how networks gain value, and it's like Google, right? I mean, in the beginning there was Yahoo search and Google search and a bunch of different searches. Well, it turns out Google had the best algorithm, and guess what? Google cleaned up and ate everybody else's lunch because of that, and they were the first with the most. And so now, if you wanted to get looks on your search, you go to Google, and in terms of if you're looking to find the stuff you want to find, you go to Google. And so it's the same kind of thing with this form of digital money. There are other cryptocurrencies, none of them have the characteristics of Bitcoin, but Bitcoin is so far and away the leader and has the first mover advantage that I think it's very unlikely that it gets replaced.
Okay, let's talk about gold now. You have an interesting chart. You've plotted gold in the orange line here next to the Fed funds rate in the blue line. I wouldn't say there's a perfect correlation, but it's certainly interesting to see both of them graphed together. How would you describe this chart? What's the significance
Yeah,
of this chart?
I think the interesting takeaway from this chart is notice how, in each of these cases, the Fed ramps up the funds rate to try and control what they thought was kind of a runaway bubble in the dot-com case. And then the bubble bursts and they realize they've got a problem and they start cutting rates. And then if you look at the yellow line of gold, notice how when they start cutting rates, notice how gold takes off. And so it happened in the 2002 to 2000 to 2002 timeframe. It happened in the 2008 to 2011 timeframe. And it happened. It's happening again. I mean, if what we talked about earlier is correct, which is to say that rates are peaking here, and I think they are, and they're going to start cutting, that's typically a real good indication that gold's about to go on a run. And so I fully expect we're going to see $3,000 gold sometime late next year.
Yeah, we know why. It's because gold is historically a hedge against real interest rates. So when the real interest rate goes up, gold goes down, and vice versa. Okay, that thesis certainly makes sense. Are you kind of surprised, Lawrence, of how well gold has performed this
Yeah,
year,
that's
despite
it's
how
great that you mentioned that.
10-year yields rising, gold still at 2,000? Yeah.
Yeah, it's great that you mentioned that. I didn't put a chart in there, but yes, you're correct. If you run a chart that shows gold against real rates, they track incredibly well. I mean, and that's how Volcker broke the gold market in 79 and 80. He just shoved the real interest rate up so high that nobody gave a shit about gold anymore. They were buying bonds at 15% for government bonds. Um, yes, and so what happened here, we know is that in February of 2022, the Fed started hiking rates aggressively, right? And they've gone from 0 to 5.25. In general, that would have taken gold down, and yet it hasn't. What it did was it prevented gold from going up. As you can see on the chart of gold, it's kind of been trapped in a range, between kind of 16, 1700 and 1900, 1950 or so. 2000 maybe at the top. And that, to me, the reason, so gold has diverged from the real interest rates. And I think the reason for that is I think gold is looking around the corner and smells that money printing is coming. In other words, it can tell that this time, yeah, they've raised the real rates, but that's a temporary thing. They cannot keep them there. They're going to, just like in the past, they're going to be forced to cut. And when they do, we're going to go party again. And
or maybe gold doesn't believe that the Fed's narrative of transitory inflation is real.
Oh, no, exactly. That's exactly right. Same difference, but that's right.
Okay. How do you feel about the gold miners? Do you like that space?
I do. I run a fund that invests in those things. They're just incredibly cheap. I mean, I would caution people, it's a very, very tough business. And it's real easy to lose money in gold miners on two bases. One, individual companies really mess it up all the time. So you've got to have a basket of them and you've got to try and pick the best management teams. And then two, they're not the kind of stocks you want to be in for 50 years. Most of the time they don't perform particularly well. But there are some short periods of time when monetary debasement is taking place when they perform spectacularly better than anything else because they protect you because they're mining a form of money that can't be printed. They protect you from that debasement. Let me just give you an example. In the 1970s, the stock market went flat to sideways for 10 years. You ended where you started, and during that, you had a couple of 30 or 40% drawdowns. In the 1970s, gold stocks went up compound annually 34% a year for 10 years. I mean, they were a major, major home run. And so when you have monetary debasement going on in a big way and you have inflation in a big way, which is what I believe we're in an inflationary environment with legitimate monetary debasement. When you have that taking place, gold stocks are a fabulous place to be, particularly if you can pick the good ones and avoid the dogs. And there are some dogs.
Well, I have to ask you why the miners underperformed the bullion this year.
Yeah, it's a mystery to me. I mean, I'll give you what I think is the explanation for it. The miners, the cost, we have legitimate inflation. We know that it's understated. And mining costs have gone up, but miners measure their cost to mine an ounce as an all-in sustaining cost. And a few years back, that was $700, $800, $900 on average. That's now kind of $1,200, $1,300 on average. And why is that? Inflation. All the things that go into a miner, oil, electricity, people, explosives, equipment. There's been big inflation in all those things. And so the cost of mining has gone up. Meanwhile, the price of gold the last couple of years has kind of been range bound between 1,600 and 2,000. And if you get on Bloomberg and you Google the kind of consensus future price estimates for gold, Bloomberg says that the average analyst thinks gold is going to be 1,750 in 5 years. Well, I'm here to tell you there's no way in hell, in my opinion, gold is 1,750 in 5 years. In 5 years, I think gold's going to be between $3,000 and $10,000. But if you were to say, if you believe the 1,750, let's say we knew that was true, and you said, okay, gold will be 1,750 in 5 years, and the cost of mining these things is going up at 10 or 15% a year because of the inflation I mentioned a minute ago. Well, pretty soon the ASIC, the cost of mining an ounce of gold will get up to 1,750, and you'll sell it for 1,750. You'll make no money. Your gold miner is worthless. It's got no profit, right? So I think that's what's accounting for the underperformance of the gold miners. I think once gold takes out this 2000 peak, and once people realize that inflation is here to stay and the Fed is full of shit on this soft landing, then I think these miners are just going to explode to the upside.
Well, if inflation is going to go up, wouldn't that just continuously compress their margins?
Well, yes and no. I mean, think about it. There's a lot of operating leverage. I mean, so if inflation goes up 10 or 15% a year, but we're talking about a move in the price of gold that could be 50%, right? I mean, I think gold goes to 3,000. I think the cost of mining will compound at 10 or 15% a year. You follow what I'm saying? And and by the way, it's also expectations of future prices of gold. If gold goes to 3,000, people think it's going to 5,000. Suddenly that whole equation will change and people will go, oh, not only are they making X amount today, but they're going to make even more as the price of gold goes higher, if you follow what I'm saying.
I do. And as an investor, do you prefer the seniors or the juniors?
Well, I'll tell you, the answer is both. I mean, let me tell you what I think is the sweet spot, okay? To my way of seeing it, I don't prefer the really big seniors because they have a problem. they have a very hard time replacing what they mine. I mean, you look at a Newmont, you look at a Barrick, I mean, they're actually kind of wasting assets. They have a very hard time keeping their production flat. And really over the last 10 years, particularly in Barrick's case, it's gone down substantially. So, if you've got a decreasing production, you're going to have decreasing revenue, and higher prices help, but not enough. The sweet spot, in my opinion, is you want to have a miner that actually is making money, medium size, not too big, but not too small, a size where they can replace what they mine every year in a reasonable fashion, and then the potential to grow the amount that they mine through either adding another mine or increasing the production at the mine that they own. So there's a whole tier of what I call mid-tier miners that, in my opinion, are just incredible sweet spot names. And I'll give out a few for free just because I love them. I've been buying them recently. One of them is Eris, another one is Argonaut, another one is Victoria. I mean, they all fit this model perfectly. I mean, both Eris and Argonaut, well, Argonaut in particular, had a big screw up. They had a mine that went way over cost, and the management got fired, and the new CEO came in, he's fixing it. But really, that created an opportunity because it's incredibly cheap. And my belief is he will fix the existing new mine. It's already running, and he'll optimize it.
What's
Go
the
ahead.
upside for you as an investor? I mean, you just highlighted a problem that a lot of people don't want to deal with, which is management or mismanagement of assets. Why put yourself in front of this potential risk? Just buy the bullion.
Well, because when bullion goes up 10%, the miners go up 30%. There's operating leverage in the miners. I mean, the bullion just sits there and it doesn't multiply. It's what Buffett says, the goose that doesn't lay eggs. A gold mine is literally a gold mine. It's a stream of future gold. And so that gets capitalized at a higher value when the market's going up. Because, I mean, a lot of these cases, these mine lives are 10 or 20 years of cash flow coming out of these things. And so if you believe the price of the metal is going to go up, and you're looking at a mine that's generating a certain amount of the metal for another 10 or 20 years, that can have a lot of value. And so, but you're right. I mean, it's a tough business, and I don't advise people to do it on their own. I mean, you can buy the indices GDX and GDXJ, and those work fine. If you know how to analyze the companies, you can pick the best ones. I would caution people to, in general, try and find companies that are profitable, medium size, and growing. I think that's the sweet spot.
Okay. Final question for you, Lawrence. You've worked in finance for many years. Graduated from Harvard Business School. Moved around a bit. Why did you eventually end up in the gold and Bitcoin space?
Yeah, that's a great question. Why are you out there in the rock picking business? So that's a good story. I'll tell you that. So I came out of business school, and the IBM PC had just been introduced, and my dad had given me a book on technology. And he said, if I were you, I'd get involved in these tech things. This semiconductor shit is real, and it's going to change the world. And I listened to him. And so I went and I got in the venture capital business, and we started making investments in technology. And I had a great run from 82-ish, 83-ish to 2000. And the kind of the climax of my career was getting all the dot-com stuff right in 93 and having a fund that went up 7x in that cycle. In 2000, that bubble burst, and my wife wanted to move. We moved, and I started coaching my kids' teams. I was kind of semi-retired, had done fine, and then the financial crisis came along, the GFC came along, and I was stunned by the reaction to that, the way they bailed out the banks, the way they printed money, the way they took the interest rates to zero, all of it. And I looked at that and I said, "Oh my God, I have a number, it's X." And I thought if I managed X carefully for the next, I was in my late 40s, early 50s, for the next 30 or 40 years, I'll be fine. I got enough. I can do what I want. And it became clear to me that based on what they were doing, X was not going to be enough. I was going to end up like my father, where he retired and the amount he had saved, got debased over time. And by the time he passed, he was down to a lot less money than he had when he retired, and on a purchasing power basis. And so I said to myself, I've got to get into something that will protect me against this behavior on the part of the government. And I studied. I said, all right, well, when was the last time we saw great inflation? Well, it's the 70s. What worked really well in the 70s? Gold and oil. All right, I'm not going to become an oil stock investor. I don't live in Texas. I don't know how oil works. It's the geopolitical. You got all kinds of stuff going on with countries and OPEC. No, I don't get that. Gold. Oh, okay. Yeah, I was kind of an Austrian economist. I knew what gold was. I knew it was sound money. Yeah, that makes sense. I've got to figure out how to pick the best gold stocks. That's what I'm going to spend my time doing. So I gave some money to a guy named Walter Cabot, very smart guy, ran one of the best gold stock funds back in that day. And he and I, he managed my money. I set up a fund parallel to that. Over time, I moved my money into my fund. I picked up investors. And so since '08, I've been kind of heads down on picking gold stocks. Going, as you know, you saw me at the Denver conference. I mean, I go to all the conferences, I meet with all the management teams and all the people. And, it's tricky. It's hard. And I've been burnt plenty of times. I've made every mistake you can make. I try not to make them twice. And
Give us one. Give us one
really
mistake.
all you can really do is try to find what I consider to be fair asymmetric bets. And what will happen is sometimes you'll be very disappointed, but sometimes you'll be very surprised. And it's what my first boss told me, Larry, this business in the venture business, he said, this is an easy business. You can lose 1x, you can make 5 to 20x. Try and find stuff that you think there's a better than 50% chance it's going to work, and you're going to be fine. Because the 1x's that you lose will be offset by the 5 to 20x's that work. And so that mindset actually works pretty well in gold mining.
Give us one mistake you've made that you can share with us that you've learned from.
Where do I start? I've underestimated permit difficulties. I mean, I've got a great company I'm involved with, but it's whether or not it's going to make it is still very much an open question in California, called Rise Gold. It's a beautiful deposit. It should be a very good company, but we've been completely stymied, and it's environmentally sound, et cetera, et cetera, et cetera. But we've been completely stymied by authorities in California in terms of getting a permit to turn it into a mine. So if I knew about politics and mine permitting, what I know post Rise, I probably never would have gotten involved. And it still may turn out good. I mean, we've got a good legal case, and we're working it. We think we might be able to force the county to give us a permit, but that was a big mistake. I've had other companies that I've backed where I didn't do enough due diligence on the management team, probably more than anything else. I think the key in the mining business is nobody knows for sure what's going to happen. Rocks are hard to figure out. Deposits are hard to figure out. But you want to have a fighting chance, and you want to know that you're dealing with people who are playing the odds and who are basically honest. And they might still lose. The rocks might go against them, but you had an honest bet that where if it worked, it was going to be 10x. And maybe you drew the short stick and it didn't work and you lost your money. But you had an honest chance. There are a lot of gold mining companies where the people are not honest and you don't have an honest chance. And one really needs to avoid those, because it's a hard enough business even if you're with honest people. If you're with dishonest people, boy, you're very likely to get your ass handed to you. And sadly, I've made that mistake a few times. I've gotten better at avoiding it, but
makes sense. Well, thank you for sharing your expertise with us. Where can we learn more about your work?
Yeah, absolutely. So I'm a loudmouth on Twitter under my name, Lawrence Lepard, at Lawrence Lepard. I have a website, Equity Management Associates. The site address is www.ema2, the number 2.com. I manage a fund. We do have openings in the fund. The minimum for a new account is 200K. That's because of all the SEC rules. We wish we could take smaller accounts. They won't let us, but anyone who's interested, feel free to reach out. I hope you don't mind my giving that shameless plug, but I do think the timing is very good right here. I think gold stocks are about to go on one hell of a tear, and buying them right here, right now, I think makes a lot of sense. A couple of years from now, when they're up 200, 300% from now, it's not going to be so obvious a bet, and I may be lightening up on this trade, but right now I'm very comfortable being balls deep in this trade. I think it's going to work really well for the next couple of years.
Excellent. Thank you very much, Lawrence. Speak to you next time.
Okay, thank you. Nice to speak with you again, David. Enjoyed it.
Absolutely. And thank you for watching. Don't forget to like and subscribe and follow Lawrence in the links down below.